Homeownership has always been an important part of the American dream and still seems to be. According to a recent national survey, 75% of respondents younger than age 50 believe that homeownership is a key indicator of success, despite recent changes in the housing market. The key to this dream of home ownership is obtaining a home mortgage. The purpose of this presentation is to better prepare you for home ownership by discussing the details of getting and maintaining a home mortgage loan. Today, we hope to shed some light on the big questions that can waylay those on the path to making a long-term commitment to a mortgage. We'll aim to help you answer 4 key common mortgage questions. How do I qualify for a mortgage loan in today's changing environment? How much house can I afford? What kind of mortgages are available to me? What changes might I need to make to my home loan over time? This Worksite Financial Solutions seminar is offered through your employer and your retirement plan advisor. Worksite Financial Solutions is a guidance-based, beginning-to-end retirement solution designed to help you create confidence in your financial life. The Worksite Suite offerings includes workplace education that's tailored to your unique needs and profile. It's also supported by a qualified LPL financial advisor who's committed to providing you with unified, coordinated advice. Whether you're joining the plan for the first time, accumulating assets, or seeking help with a career transition, Worksite Financial Solutions pulls all aspects of your finances into a single, manageable focus that will help you save time. Understanding what it takes to get a mortgage loan can seem like a full-time job in itself. But really, once you have some basic information, the process won't seem so overwhelming. Knowing where the market has been in the last few years and where it may be going can be helpful in understanding the big picture. Mortgage rates have been at historic lows over the past 5 years, but they've recently begun to rise steadily. Interest rate gurus Bankrate.com predict mortgage rates will keep climbing over the next year. However, experts at Bloomberg.com say lower job growth and a slow economy will keep rates fairly low, thus helping them remain a great value in the near future. More good news for home buyers. The inventory of homes for sale is on the rise after a few years of market drought. The folks at Realtor.com say that we're going to see more inventory becoming available. Home buyers and home mortgage seekers may find this an opportune time to find a home for themselves and their families. Personal financial planning decisions are some of the most important you'll make in your lifetime. Where you go to college, what career field you choose, even who you marry and how many children you have will all affect your personal financial goals. Buying a home and obtaining the right mortgage loan are a big part of meeting these personal financial goals for you and your family. Planning for the next step, creating a system that will get you there, and having the discipline to keep going is the way to smart home ownership. Buying a home is something everyone can do, but it will take a commitment to work the system you put in place. The down payment will be the most significant expense of obtaining a home loan. Down payments can vary from no down payment, none at all, to all down. But 20% of the purchase price is what you'll generally need to get the most favorable mortgage terms and avoid the purchase of PMI. PMI, or private mortgage insurance, is an insurance policy that protects your lender in case you default on the payments. As a borrower, you pay the premiums and the lender's the beneficiary. PMI fees vary from around 0.5% to 1% of the original loan amount per year. Paying down your current debt is also an important part of getting the best mortgage package. Reducing your total debt can help you qualify, lower the interest rate in your loan, and free up more monthly cash flow to pay the new payment you'll have. Mortgage loans can make home ownership a reality, but finding the right mortgage for the right home is a time-consuming balancing act. During your research, planning carefully and having all of the information will help you make the mortgage decision that's right for you. The monthly mortgage payment's usually the single largest family budget item, which experts tell us should work out to around 25% of your gross pay, or 35% of your take-home pay. Statistics tell us that the average length of time most people own a home is 9 years. If that's true, should the average person choose a 30-year loan? In addition, should your highest financial planning goal be to pay off the mortgage, or to invest for retirement and/or to build an education fund for your children? Though finding the right mortgage can be tough, it's well worth the effort if it helps you achieve all the goals you have set for yourself and your family. In order to begin shopping for a home, most realtors will prefer that you be pre-qualified by your lender. While not a loan commitment, this does mean that you meet some basic requirements and stand a good chance of being approved for a mortgage loan. Real estate experts tell us that your purchase offer on a home has a better chance of being accepted if you're pre-qualified. There are three basic elements of pre-qualification. 1, your credit score. 2, your debt-to-income ratio. And 3, the cash you've saved for a down payment. Credit score requirements have changed a lot over the last few years, and they'll probably continue to vary some. Right now, you really need a score of at least 680 to get a good loan rate, while an ideal score of over 720 will enable you to get the best loan rate. If your score isn't up there, take action now to improve it. Order your credit report so that you can identify and begin to handle any problems right away. Your proposed monthly mortgage payment, made up of your principal plus interest, will be divided by your gross monthly income before taxes. This figure shouldn't go over about 28%. For example, let's say you earn $5,000 a month in take-home pay. You may be able to afford to spend $5,000 times 0.28, which equals $1,400 on your mortgage payment each month. Your total debt will be divided by your gross monthly income. This amount should not go over about 36%. Keeping with the previous example, if you earn $5,000 a month, you may spend $5,000 times 0.36, which equals $1,800 on your total debt obligations. That said, if you have a mortgage payment of $1,400, you can spend an additional $400 a month on credit card payments. Please note that this is a hypothetical example. Your amounts may vary depending on your specific situation. Keep in mind that you'll need to have money for a down payment and closing costs. In addition, there are government loans that allow you to put little or no money down, which asks the seller to pick up the closing costs. However, if you get a conventional loan, you'll need money in the bank for the expenses. Lenders generally want to see a down payment of between 10 and 20% of the total purchase price. A home is more than just an assortment of bathrooms and bedrooms and countertop finishes. A home is where you'll spend most of your free time and where you'll make family memories and entertain friends. Making a good choice for your family is important. Doing your research online is a great way to get to know the neighborhood. You can find out home values, property tax rates, crime rates, and other important general information about an area you may be interested in. You should find out about the school district associated with the area you're looking at and call for an estimate of home insurance rates from your insurance agent. You should also consider things like your daily commute, local recreational and cultural activities, and the homes in direct proximity to the one you may be eyeing. The people living there may be your neighbors for quite some time. All of this planning and research sounds like a lot of work, but consider the alternative. No one wants to buy a home he or she doesn't like, in a neighborhood he or she is unhappy with, or get stuck with a mortgage product that doesn't fit his or her needs. Consider Dan and Kate's story. Dan and Kate lived in a small apartment in a major metropolitan area with their 2-year-old son, Ryan. They were accustomed to walking or taking mass transit to and from work, eating out in hip restaurants, and enjoying various types of city entertainment. They loved the culture and feel of city life, but found that growing their family in the city may not be what they want long term. Kate soon found out that she was expecting their second child. Before they really had time to plan or think, they made an offer on a 3-bedroom, 2-bath home in a beautiful subdivision outside the city. They had to take a 0 down payment loan with PMI because they hadn't saved enough for a down payment. Their justification for this was that the investment in a family home would make up for the extra expenses of the new home loan. Soon after their move, Dan and Kate became miserable. Despite living in their beautiful new home, they now faced a long commute to work and the burden of caring for, paying for, and repairing all of the extra space. They hadn't really sat down and thought about all of the changes this new house would bring to their budget or to their lives. They had to buy a second car for the 45-minute commute each day, which cost more money that they hadn't considered or factored into the budget of their life away from the city. Dan and Kate didn't take the time to plan for smart home ownership. All their options now are difficult. Even selling for the same price will mean they're out all closing costs and extra expenses, like the second car. They feel stuck in their new home and new situation, but now need to try to accept it and possibly learn to like it. For many people, the increase over time on the real estate investment made in their primary home may prove to be their largest single asset. However, that home will potentially also be their largest monthly expense over the same period of time. Carefully choosing a home and the right mortgage are critical to having a solid financial plan. How you choose to use each dollar of income now will decide your financial health later. Major family financial goals include home ownership, education, retirement, and vacation savings. Each goal needs attention and thought, along with careful planning for how each will be provided for in the overall picture. Smart home ownership is about more than getting the most house for your money and should consider the ability to meet each of your personal and family financial goals. The general rule of thumb is that you can afford to buy a house that's equal to 3 times your annual household income. Using an online financial calculator, like those found at bankrate.com, can help you to determine how much home you can afford. Remember that it's just a general rule. Being house poor does not mean you can't afford to buy a house. It simply means the cost of ownership keeps you from other important things, such as vacations, saving for retirement, paying for education, and perhaps even from purchasing or owning a reliable car. You'll want to consider your other financial goals. Consider questions such as, do you want to save more for retirement? Are you just starting a family? Do you have children heading to college soon? Your life stage and goals should help you determine how much you want to spend on mortgage payments each month. Lenders have minimums and maximums, but don't push those limits just because you can. Remember Dan and Kate in their struggle to like their new home outside of the city? After they've accepted their new life, they made a few adjustments to make their new home better. They eventually added an outdoor entertainment and play area for the kids, as well as a pool. To do this comfortably, they drove older cars, and as the cars got older, the repair bills got higher, which cut into their vacation money and their kids' college savings. Fixed-rate mortgages allow for repayment of a debt in equal monthly mortgage payments over a specified period of time, from 10 to 30 years. A 30-year mortgage is most common. Payments are credited first to interest and then to principal. If you can afford this loan and plan to live in your home for 10 or more years, this may be the best option for you. Unlike a fixed-rate home loan, which holds the same interest rate over the life of the loan, the interest rate on an adjustable rate mortgage, or ARM, changes every year. ARMs come in many versions. For instance, a hybrid ARM features aspects of both adjustable and fixed-rate mortgages. Hybrid mortgages can be anything from a 3-year, 5-year, 7-year, or 10-year fixed interest rate period, according to Pacific Coast Lending in Agora Hills, California. After the fixed rate period, the loan is amortized over the balance of the term with a rate that adjusts annually. This can get quite expensive quite fast. Generally, adjustable rate mortgages are for those who intend to sell their home in a short period of time or will refinance into another mortgage product for whatever reason at a later time. For those buyers who need a rock-bottom payment for several years, the interest-only mortgage product, as its name implies, allows them the option of paying only the interest for the first few years of the loan. You can pay principal if you wish. Interest only is an option. Interest-only loans are structured like an adjustable rate mortgage. An interest-only loan may be appropriate for home buyers who believe their income will increase in the coming years. For instance, young families or a professional just starting out. This chart looks at the features of a 5-1 adjustable rate loan. Life changes, and so do interest rates and home values. Sometimes it makes sense to refinance a mortgage, but the choices can be confusing. Sometimes it's best to pay off the mortgage in full. Before you jump into a new mortgage commitment, run several what-if scenarios to find your best option. The questions of refinancing will keep coming up, especially for those with adjustable rate mortgages as interest rates begin to go up. When deciding whether or not to refinance your mortgage loan, some key pieces of information are necessary in order to make a good decision. The interest rate, loan balance, and remaining number of months on the current loan are important to compare to the interest rate, number of months, and fees on the new loan. Mortgage calculators that are available online can help to make you a savvy shopper. Remember to compare the monthly mortgage payment amount and how long it will take to pay off the new loan before deciding to refinance your current mortgage. Think carefully before jumping into a new mortgage loan, and remember, if it sounds too good to be true, it probably is. I've included a mortgage refinancing worksheet to help you gather the information you'll need and prepare for the comparisons you'll want to make. Home ownership is not a retirement plan. Your home may be your biggest asset, but housing prices tend to go up and down with the market. Retirement planning includes mortgage planning, and mortgage planning includes retirement planning. Remember that they go hand in hand. Before you make the home buying decision, get a big picture view of your financial plan. The rule of thumb for annual earnings may be 25% for the home, 20% toward retirement, 10% for savings, 10% for education. These are time-tested guidelines and recommendations, but you'll have to make your own adjustments. Whether you work with a financial advisor or do your own planning, you may be more successful if you face the challenge of managing the competing goals for your earnings. At times, it all may seem daunting, but it's more about making one good decision at a time. And remember consistency with debt payoff. Start as early as you can so you can build your credit score and home equity. Enjoy the good feeling of knowing you're accumulating a retirement nest egg and an education fund while living in a home you and your family enjoy. My goal today was to give you guidelines, tips, and tools to help you make great decisions. The handouts include organizers and checklists with sources of online calculators. I hope you find them helpful as you search for the right house and the right mortgage. Thanks for your time and attention during this presentation.